Supplemental property taxes. If you're buying a property in California for more than it last sold for, chances are you'll be receiving a supplemental property tax bill or two in the mail in the months following the transaction. Let's talk about these supplemental taxes. First, in order to understand supplemental property taxes, you'll need to understand the California property tax system as well as Proposition 13. In California, the way the property tax system is set up is that when a property is sold, its assessed value for property taxation purposes is readjusted to the sales price of the property. Now, since the passing of Prop 13, from the date of the sale forward, the maximum annual increase in the assessed value is limited to 2% per year. For example, if a property sold in January of 2020 for $500,000, then the maximum allowable assessed value in 2021 would be $510,000 and so on. So if the housing appreciation rate is 5% annually for the next 5 years, the assessed value is still limited to only increasing 2% per year. So for example, let's say you buy a property for $500,000 and the assessed value at the time of the sale was $400,000. So once you close escrow, the property will be reassessed at the sales price of $500,000. Now, to determine the supplemental assessment value, that is, the difference on which your supplemental taxes will be based, the county assessor will subtract the property's prior assessed value from its newly assessed value, and the difference between the two is the net supplemental value that will be assessed and applied as a supplemental assessment. Now understand this, the supplemental assessment could be either a positive amount, or let's say in the case of a reassessment that results in a value that is less than the prior assessed value, it could be a negative amount as well. Now the fiscal year runs from July 1st to June 30th. And the supplemental tax, or refund if the new value is less than the old one, becomes effective the first day of the month following the sale, and the amount is prorated based on the number of months remaining in the fiscal year. Here's a table showing the factor to multiply the supplemental taxes by. If, for example, you purchased the property mentioned above in September for $500,000 and the previously assessed value was $400,000, then the supplemental assessment value would be $100,000, the increase in value. You would then take this amount and multiply it by the tax rate for your area. Now the average tax rate in much of San Diego is approximately 1.25%. So in this case, that would be $1,250. You would then take that amount and multiply it by the factor for the number of months remaining. Since the supplemental tax goes into effect in October because the sale closed in September, we would multiply that by 0.75, giving us a supplemental tax bill of $930. Now, if you close between January 1st and May 31st, then you'll receive two supplemental tax bills. Since the new fiscal year begins in July, the second supplemental bill accounts for the property's change in value for the 12 months of the coming fiscal year. Now, keep in mind that these one-time supplemental property taxes will not be paid out of your impound account with your lender, so you'll want to make sure you take care of these yourself. Is your head spinning yet? This can be a confusing topic, I know, so I hope this cleared it up for you. Hey, if you're still confused, feel free to give me a call and I'll be happy to explain. I'll see you in the next video.